let's say you borrow $100 and you use that money to buy a piece of equipment. Okay.
Okay.
Walk me through how that flows through the three statements in the first 2 years.
Sure. First 2 years. So you borrow $100, and is that through debt? Do we have an interest rate on that?
Well, you borrowed $100, so is it through debt? You tell me.
Oh, okay. And I guess what's the interest rate? Interest rate then?
Say it's 10%.
10%. Okay. And well, I guess I'll just ask all my questions up front then. And what's the how are we gonna depreciate the PPE?
How is it typically depreciated in your opinion?
Like straight line, like sorry, straight line depreciation, depending on like what's the expected sort of lifespan of the thing. So
Okay. So what do you really want to know?
it's well, you sell about $100 for that thing, and you want me to walk through the first 2 years. I don't know how long, how long that thing gonna last in, let's say 10 years maybe.
Say 5 years.
Okay. And what's the I guess tax rate? I was gonna use that in the end. 40%. 20%. Okay, cool. So I guess 2 years. First year on the income statement, there's nothing, and on the cash flow statement, there's cash down $100 from capex, cash up 100 from debt. That's all zero. And balance sheet, asset up, PP&E, sorry, asset side, PP&E up 100. On the debt, on the liabilities side, debt up $100. So stockholder equity doesn't change. It's the first year. And second year, and there's something in the income statement. First of all, is depreciation. It's $100, 5 years. So depreciation is $20, and 10% interest rate. So there's interest expense $10, and so pre-tax income down $30, and net income down $24. And on the cash flow statement, net income down $24, add back depreciation, which is $20. And do we like, is there any payback on principal or no?
Let's say no.
No. So sorry, net income down 24, and add back non-cash expense depreciation $20. So sorry, ending cash balance down $4. The balance sheet, cash down $4, PP&E down $20, just 24, asset down 24 in total, and liability pay downs $10. So in order for that to balance, stockholder equity should go down by $14.
Liability pay down is $10. Why?
Wait, where pay downs $10? The liability.
You said liability pay down is $10, so stockholders' equity is down by 14, right?
Yes.
Why is the liability pay down $10?
Nope, there's liability doesn't change because there's no principal payback. So stockholder equity down 24 actually.
Why is it down 24?
To balance the in order for balance sheet to balance on the asset side, it's down 24. Liability doesn't change. Stockholder equity down 24.
So where is the 24 coming
Coming from the net cash balance down 20, and PP&E down 20. sorry, net cash balance down 4, PP&E down 20, combines minus 24,
Yeah, but what's feeding into shareholders' equity?
net income.
Okay. Okay. All right, so a couple comments here. I mean, look, you know this stuff. I can tell you know it. I think that delivery just needs to be more crisp and needs to be cleaner. Like you're making silly mistakes like saying there's a debt pay down $10 right after you asked me if there's a principal pay down. I said no. Right?
Yeah.
You're also like the way you ask questions needs to be more precise. So for example, like I tell you, hey, you borrow $100 to buy a piece of equipment, walk me through how that flows through the 3 statements. And you ask me if that's debt, if that's financial debt, right? I just told you borrow this money. That means it's automatically you can assume if you borrow the money, it's debt. Right? You borrow money, you gotta pay it back. That's automatically debt. So I wouldn't even ask that question, right? You ask, how will we depreciate the PP&E, right? Then I asked you, well, how do you think we should depreciate it? And then you said straight line, which is correct. Like the automatic default assumption should be straight line if they don't say anything. But what you were really trying to ask is, so I asked you, like, so what do you really want to know? And you're like, how long does this, property, or how long does this equipment last or whatever, right? Like what you're really trying to ask is like, what is the useful life of this equipment, right? Not how would we depreciate the PP&E? I was just giving you a hard time, but like you're gonna run to interviewers that are just gonna try to give you a hard time as much as possible, right? So I would have just asked like, okay, so what's the useful life of this equipment? And I would just told you 5 years. Does that make sense?
Yes.
You can assume that's 5 years straight line. Right? You don't have to ask about the straight line part. And then I think like another thing that's a little bit more like nuanced is when I said walk me through the first 2 years, walk me through how that what happens to the financial statements in the first 2 years. Technically, like that could be 2 calendar years, right? And technically, when you buy the PP&E, that could be treated as year 0. Like that's when T equals 0. That's when I'm buying the equipment today, CapEx is going out, but no time has passed yet, right? Year 1 is when I depreciated by 20%. And then year 2 is when I depreciated by the next 20%. So technically that could be the definition of 2 years. Does that make sense?
Yes.
Whereas what you did is you treated year 0 as the first year, even though no time has passed. And then you did 1 year of depreciation after that. And I could say that's only 1 calendar year. Does that make sense?
Yes.
Okay. So you want to be careful with that. And then like, look, if it's unclear, like I was intentionally vague, like you might want to clarify. And I say, hey, oh, sure. So before I start, just to be clear, we're treating the purchase of the asset as year 0, and then you want to go 2 years beyond that. Is that what you're saying? Okay, got it. Right. Does that make sense?
Yes.
Okay. I hope you enjoyed this video. If you're looking for more customized advice that's tailored for your specific situation, then I invite you to book a free strategy session with our team at the link below. We'll talk to you soon.